Good morning, Facebook. I'm Jill Malandrino with the Voice of America, and this is Nasdaq's Facebook Live. Joining me is Phil Davis of Phil's Stock World. Phil, are you kind of surprised to see this morning just how much we have opened up in the market, considering all of the news that we've had to contend with over the weekend?
I mean, I was surprised, but I'm not so surprised now because we've been tracking something that's very interesting, which is we've crossed a threshold where there are now more ETFs and index funds than there are stocks.
Right.
So
okay,
think about that.
Even with like a massive global cybersecurity attack,
yeah,
essentially affecting every country. And I get why cybersecurity stocks are up. But
yeah.
so we go from 1991, which was the low, right? When was this back? The low in June of 2016, and that's even when we started off the chart here, right? From February, which was the low of the year, when we started down.
Started 1850, which is
right.
way down here.
And look at where it is now, 2403, and this is as of about 10:15 this morning. But that's an incredible run.
Well,
and you seem to think that it's because of ETF and indexing.
It's because of what you call dumb money. It's ETFs and index funds. And they mindlessly buy. Every time you put money into an ETF or an index fund, it buys every stock in the fund and every stock in the index, regardless of whether they're good or bad. It's what they call dumb money. It just basically just comes in mindlessly and buys up whatever it's indexed to. With the massive amount of funds that have been created and are taking money, and also all the new job creation of the last few years means more and more wages go into 401ks and IRAs and such. So every week when someone gets paid, they automatically, no matter how toppy the market is, every week somebody gets paid, they're automatically putting more and more money into 401ks and IRAs, which put more and more money into the market.
Right. So I guess instead of stock picking these days, you should just thematically pick your ETFs. Is that like the new stock picking, if you will?
No, not really. I mean, you still no. In fact, frankly, as stock pickers, we vastly benefit from this because we can pick out the low-hanging fruit, the things that haven't gone yet, and we know that if everything else gets bought, then this is going to get dragged along as well. So we look for things that are like laggers in a sector that haven't come along yet, and you know that they're underrepresented in the funds, or there's certain reasons that they don't get picked up. Like we were just talking about Fiat Chrysler in a previous thing. You pick up guys who haven't caught on because Fiat Chrysler, for example, is not indexed the way Ford and GM are. So Ford and GM have gone like that, and Fiat's like lagging behind, but still slowly gathering steam, and eventually more and more people catch on to it.
Right. So then overall then, because I'm trying to understand this, we should just ignore fundamentals and what's happening around the world? Because I mean, I've been working with you for 18 months at this point, and we keep finding fundamental excuses as to why the market's overvalued for the most part. There are some sectors like tech. I understand why tech is running. I totally get that. But are we just supposed to ignore geopolitics and macro events and so forth?
Well, you're killing me because that's like my job. I'm a fundamental analyst.
Right.
But I have to agree with you that, yes, the fundamentals are out the window. Since Trump took office, there's this irrational sort of exuberance about the market and what's going to happen, and now everybody's excited about the tax cuts, and everybody's excited about getting rid of Obamacare, which I don't understand why that's exciting to people, because it's going to be incredible. It's going to kill jobs. It's going to destroy health insurance costs are going to go through the roof, so on and so forth. There's all kinds of horrible things that are about to happen. But it doesn't matter. Everybody's sort of buying into this concept that, like, everything's pro-America and pro-bullish and pro-markets right now.
Right. So you have not only irrational exuberance, but you have ETF and indexing. It's almost a perfect storm to set up for the upside. And what about those asset classes that aren't participating? Are they just going to continue to be ignored?
Well, no, they'll go in and out of favor. See, the thing is, look, you can think that Amazon's way overvalued. You can think that Facebook's overvalued. You can think Tesla's overvalued. But you know what? When you buy the QQQ, it doesn't matter. You're buying, so you go, oh, they're overvalued, but the Nasdaq's in good shape.
Right.
That doesn't really make sense, honestly. I mean, other than Apple. Frankly, Apple's like holding the whole thing up anyway. It's actually undervalued. And it's 10% of the whole index.
Well, it's really interesting that you say that, because it seems as if there's a basket of 15 to 20 stocks that are driving this entire market.
Yeah.
Back to what you said with the Nasdaq, trading over 6,000 and continuing to break all-time highs. But I'm curious to see, not that I want to see this, but if there are a pullback in that, if there is a pullback in those 15 to 20 names, that's really what I think is going to be the catalyst to send shockwaves through this market.
Oh, massive shockwaves. That's right. This is the dirty underside to what's going on now. It's like I said.
It's almost like the Fed used to prop up the market. Now it's like these 15 to 20 massive stocks that are.
Yes, and the thing is, this is the problem. So you look at Amazon, you say, look, Amazon doesn't really make much money, and they're valued at $100 billion plus. they don't make enough money in any way, shape, or form to justify where they are, like 300 times earnings they're trading at. Tesla makes no money at all, and they're worth more than Chrysler or GM. That makes absolutely no sense. So you have these ridiculously overvalued stocks, but they're hiding in an index that's fairly valued. It's growing, the Nasdaq itself is growing fairly well, and it only takes a certain amount of stocks, those few stocks that do make good money, prop up, like Apple, making $10 billion a quarter, makes the entire, so when you invest in the QQQ, this is the thing, when you invest in the QQQ, you say, oh, this is wonderful because the QQQ earnings are up X amount. It's only 3-4 stocks that are making the earnings up that amount, but that justifies you buying the index, which then in turn, the money feeds into Amazon and Google and so on and so forth, even though they're toppy.
But I would also argue there are other sectors of the market, like, for example, cybersecurity is a great thing to talk about today with everything happening over the weekend. The semiconductor index, by not only are they participating being tech stocks, but they've shown it in their earnings. Look at, LRCX, look at a number of the other companies that have reported well. And I think cyclically, people are coming back into the tech sector.
That's what I'm saying. The people will rotate. So as the indexes themselves get toppy, people will then start rotating to look for the sectors they haven't been involved in yet. So you come back to tech, you come back to real estate. Retail right now is getting hammered down. I mean, people think retail is dead, but you can look outside here and see people shopping all over the place. It's not.
I mean, Times Square is also an anomaly. It's
not. Yeah, but I'm just saying conceptually.
In the middle of nowhere.
Yeah, but still, I mean, it's honestly, retail's down 10%. It'll stay down 10% because Amazon took 10% of their business. This is very logical. But Amazon's not going to rocket up to 20% of the business.
Right.
So they're going to maintain where they are. They're not all heading for bankruptcy. They're going to have to resize and downsize and change their ways a bit, but it's not a wipeout of the sector.
Well, it's really interesting. I want to go back to Macy's because I know it's a name that you like, particularly for the real estate story, and I can understand that. But do you think, and this is just a hypothetical, is there a place for department stores anymore? Kind of like Home Depot and Lowe's took over the mom and pop hardware stores. Maybe that large department store format is just not indicative of the way people shop anymore.
Well, no, like you're saying, Lowe's and Home Depot wiped out the small stores.
Right.
It's the smaller stores that get in trouble. The bigger stores, well, look, Amazon's opening retail locations now because Amazon realizes they've hit the limit of their growth without having a retail presence. So they're going to start opening retail stores.
Right.
They're going the opposite direction while people are closing down.
I'm curious to see if people would want to see what an Amazon store looks like. Is it a giant warehouse? Is it like Costco format? But I think one thing that the department stores are missing, this is why you'll see them opening up boutique shops or pop-up shops within the department stores themselves, is with something that big in a mall, you're not able to share an experience. Whereas if you walk into other stores, it's an experience, it's a cool place to hang out.
Yeah.
Which is why I think you see those pop-ups.
Well, the pop-ups are smart because they want to cut back on if Macy's wants to cut back their square footage, they can either close a whole store or they can rent out 10% of their existing store to pop-ups.
Right.
And that makes great sense for them because it's nice for them to have the presence. Best Buy started that actually with the Apple and Microsoft pop-ups inside their stores.
Right.
And that was very successful.
So I think that could be a continuing theme in the retail sector. And I want to wrap it up with one more group. How about healthcare? Because you were talking about that before. It feels like that's one sector that's also in limbo because it really is contingent on policy.
Well, healthcare now, in 2010, we were super bullish on healthcare as Obamacare was rolling out. And everybody was saying at the time it was going to be horrible for healthcare. I'm like, why would it be horrible for healthcare to add 30 million people to the healthcare? That makes no sense. So healthcare since then has been up about 50%, just basically racing along all the healthcare stocks. And we had tremendous success in 2010. Now we've actually soured on healthcare because we don't think Trump care, or whatever you want to call it, is going to have essentially the opposite effect and drag money away from those stocks.
Right. Because if we're adding 30 million people, if you detract 24 million, it kind of seems like
yes.
We just subtract, that's not a good thing.
It's not just that, though, but you're not just, here's the funny thing. You're not just subtracting 24 million people that are going to lose their health care entirely. You are adding a tremendous cost burden to the 130 million people who have health care. Right. All of a sudden now the people who have health care are going to have their deductibles shoot up. They're going to have their copay shoot up. They're going to have they're going to have caps on their long-term care. This has not happened to people before. They don't even understand what's going to happen. You're going to go for dialysis, and after you go 10 times for dialysis, which you need to live, they're going to tell you, sorry, your 11th time is going to cost you $70,000. And people are going to go, what? And they're going to be, well, you hit your cap. Hey.
Right. Right.
That did not happen before, and it was forbidden to happen under Obamacare. It is now free range for on the new healthcare plans. It's going to be a complete catastrophe.
All right. Well, we'll see where we are in just 2 weeks. Actually, you'll be joining me on the 30th because we will be off on that
Tuesday.
Monday. Yes. So we'll look forward to having you back on Tuesday, May 30th. And as always, Facebook, thank you for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.